Hey everyone, in this tutorial I'm going to show you how to buy shares of stock using Webull's OTO option, which stands for one triggers the other. Depending on the broker, it may be called one triggers another, but they work the same way. Just a heads up, I will be mentioning a few off-topic details throughout this video that new investors and traders might want to know before jumping in with real money. So before I get into the tutorial, I will mention that I recently transferred my entire stock portfolio from Robinhood over to Webull, and the OTO feature was not available on Robinhood. If you are someone that has little to no experience investing, swing, or day trading but want to hop into the stock market from your phone, I'd recommend Robinhood strictly for short to long-term investing. Meaning, if you don't care about news, patterns, trends, or watching candlesticks because you know historically the market generally uptrends about 70% of the time anyway, then by all means invest some money into a Robinhood account and let it grow over time. Now, if you are actively watching candlesticks, market trends, patterns, and volume, you should strongly consider Webull if you can't decide between the two, because there are a ton of indicators and other useful information on Webull that Robinhood doesn't offer. Both have excellent customer service and user-friendly apps, although there are plenty of other brokers to choose from. It just depends on your financial goals and personal preference as to which one will work best for you. Okay, so how does the OTO order form work? You'll start with a primary order, either buying a certain amount of shares at market price or placing a limit order. In this example, I'm going to place a limit order for 6 shares of GameStop at $4.50 and assign an action for each share before sending the order. The primary order can be for as many shares as you want and can be divided in a variety of ways using 1 to 6 secondary actions. And if you wanted to keep a portion of shares, you can do that and only place an action for shares that you are willing to let go. You'll often hear OTO positions described like it's a type of autopilot feature filling in if you're not available, and in some ways it does. But if you're under the impression that you'll not only be able to set stop losses but also set limit orders to automatically buy more shares if an uptrend happens while you're away from the computer, it will not get triggered at those higher prices. Instead, as soon as the primary order is filled, all limit orders attached to the OTO will be filled at the same time. In the exact same way, if you place an individual limit order for $5 and the current market price is $4 per share, once submitted, that order will instantly be filled at $4, not $5. In other words, you'd be buying at market price from the limit order screen. So if this order were to go through, I would have a total of 9 shares of GameStop instead of 6. This is something that really needs to have a clear direction and exit strategy before sending. If not, you'd be better off placing individual orders and closely watching the charts throughout the day. If you change your mind after the order has been submitted but not filled, you can still cancel it. And if the order gets filled after the fact and you decide the strategy was bad and needs to be changed, you cannot modify any of the secondary orders. That includes raising or lowering the numbers on the fly like you can do with a regular limit or stop loss order. However, each individual action or all remaining secondary orders can be canceled. A manual stop loss can be sent afterwards if needed for the remaining shares. Ideally, the trend should go up, but since this is a one triggers the other situation, that means if things go south, the first stop loss order will be filled. Now, my account doesn't have day trading restrictions, but it's my understanding that from this example, let's assume the total value of your portfolio is less than $25,000. If all 3 stop losses were triggered, that would count as 3 day trades. If you were to make 4 day trades within a 5-day trading period, you will be flagged as a pattern day trader and your account will be restricted from day trading for 90 days unless you transfer more money into the account to get your net portfolio value above $25K for cash accounts not using leverage. Of course, you'd still be able to swing trade any shares that you've already purchased and future shares during that time. This is in place to protect people from blowing up their account and is a standard legal practice for brokerages in America according to FINRA, the Financial Industry Regulatory Authority. I still need to experiment with different strategies, but I see this as a great tool for day trading, especially if you won't be able to check the app that often during trading hours, but something I probably wouldn't use if I had a smaller account. For short, mid, or long-term investing or swing trading, I'll most likely stick to manually sending in each order so I can modify my positions quicker as things change. If you found this helpful, be sure to check out my Easy Tutorials playlist for more content like this. Thanks for watching, and I'll see you in the next one.